Hi there, it's Brad Flynn again. Today we're going to be looking at another really important part of your business that you need to understand. It's another one of the financial statements. This one's called the balance sheet. Now we've covered off the profit and loss statement, and now we're going to look at something that is equally or sometimes even more important, which is called your balance sheet. To your average business novice, not necessarily novice, but someone who's relatively new in business, the first thing that they generally look at to assess the health of a company is a profit and loss statement. But for the business owner or the entrepreneur who's more experienced, the generally first thing that they will look at will always be the balance sheet. So my goal today is to give you a bit of a broad overview of how a balance sheet works and how it all hangs together. For better information, for more detailed information, you're going to need to talk to your accountant. Now, as with a lot of the things that come with financial statements, the accountants do their wizardry, I guess you'd say, with them in terms of manipulating the numbers and so forth. So as you're reading your financial statement, if it doesn't make sense, you can check with me, your coach, first, and if I'm not able to help you, then I'm going to refer you to your accountant. So now let's get into it. From previously with the profit and loss statement, we know that the profit and loss is all about the past. Now today we're going to be looking at your balance sheet, which is a snapshot of your business right now, or whenever the point is referenced when you generate the report from your accounting software. So, broadly speaking, the balance sheet, as the name suggests, it must balance. And as I go through this, what that means is going to make more sense. But essentially, it's the assets of the business minus the liabilities that give you the equity, or what the business owns minus what the business owes to give the net worth. Now, if we use your personal situation for an example, your net worth is same sort of formula as this: what you own minus what you owe to give you your net worth. So what you own might be your house, your car, any bank accounts you've got or anything like that, minus if you've got loans on all of those things, gives you your net worth. All right, so there's a bit of a comparison for it. So let's go through it now, what the different elements mean and how it all hangs together. So I've set up a bit of a mock-up example here to teach you the concepts of it. Now, assets. In terms of assets, what we're looking at are things that you actually own. So things like cash in the bank, any accounts receivable that you have that people owe you money for, inventory that you have, and anything that is either property, plant, or equipment. Anything that you own, or the business owns, to be more precise. Now, liabilities, over on this side of the equation, we've got things that you owe. So, if you've got an overdraft or credit cards or anything like that, that you owe money for someone, that you're actually an accounts receivable for to somebody else. Your accounts payable, what you owe your suppliers. So if you've bought a whole heap of product and you've got it on credit, then this is the amount that you owe them. Any tax obligations that you may have accumulated, be it your pay-as-you-go, company taxes or BAS or anything like that, they're also a liability. And down the bottom here, any loans that you might have taken out as well to buy the assets that you're looking for. Now generally we'll divide assets and liabilities into two subcategories. They'll either be current or non-current. Current means short-term. So current refers to the liquidity of a particular asset or liability. So with cash, accounts receivable and inventory, generally we could convert them into money fairly quickly. Similarly over here, our liabilities, we would need to possibly pay them fairly quickly. When I say fairly quickly, generally within a 12-month time frame. For non-current assets or liability, the definition generally extends beyond 12 months. So things like property, plant and equipment that you wouldn't be able to get rid of as easily or turn into cash. And similarly, if you've got long-term loans for 3 or 5 years or whatever, they're generally referred to as non-current. Now, over here with our equity, and as I get to the back end of this, I'll explain this in a bit more detail. Equity by definition is the shareholders or the owner's stake in a company measured by accounting rules. So you may have noticed that sometimes these accounting rules seem a little bit odd and a bit hard to get your head around, but that's the way it is. When you're in business, if you're going to be swimming with the sharks, make sure you're not a tuna. How you go from being a tuna to a shark is to start to understand how all this works together to be better able to make better decisions. The other thing that equity is sometimes referred to is the book value of a company or the net worth, right? But that's not the value of your business. The value of your business is what someone's prepared to pay for it. Of course, they'll take all of this information into account, but it's not a direct correlation to the equity in your business. It's your stake in the business. And as I go through this, it'll probably start to make a bit more sense. So, now what we're going to do is start to have a look at some numbers. So in this instance here, we've got $10,000 cash in our bank account, so for our assets. We've got $5,000 that's owed to us. And this is also an interesting thing that happens with accounting in your business. Quite often a business owner will say, hey, I'm doing really, really well. My profit and loss on my income statement, they're the same thing, says that I'm making all this profit. But where's the money? More often than not, it's probably sitting over here in someone else's bank account. Okay? Profit and loss works slightly different to what most people understand it to. In that when you get a sale on a profit and loss, it's when the invoice is actually sent out, when the invoice is generated and sent to the customers, not when the cash comes in. It sits over here in the meantime as we're waiting for it as an asset for the business. Alright, so here we've got accounts receivable of $5,000. If that doesn't make sense to me, talk to me in one of the coaching sessions and I'll explain it to you in a bit more detail. Inventory, of course, you've bought a whole bunch of stuff and it's now sitting in your shelves or wherever it is. And property, plant and equipment of 100 grand. So you might have some vehicles, you might have some planned equipment, maybe you own the property, whatever it is. So our total assets, adding all these up, 10,000, 5,000, 7,000 and 100,000 equals 122,000. Now we go over to our liabilities for our little pretend business here. So this is what we owe. So in this instance, if we've got an overdraft, at the moment, we're not in overdraft. Fantastic. Zero. Our accounts payable, what we owe to other businesses, $8,000. Tax, at the moment we owe $4,000 in tax. And we've got $50,000 in loans. So our total liabilities in this example is $62,000. Now we go across to the final column. Now as the name suggests, this is a balance sheet. So this side must always equal this side for it to balance. It is a fundamental rule in accounting and it can't be messed up unless you've got the numbers around the wrong way somewhere. So, equity in this instance. Let's start from the bottom line and work up. We've got 122,000 in assets minus 62,000 in liabilities gives us a total equity of $60,000. And if you go to the bottom of your balance sheet, that's the number you will see. Balance sheet equity is sometimes divided into different areas or different accounts. So the common accounts used in Australia are something called retained earnings and current year earnings. The other thing that you might see in there is shareholder earnings as well, but that's again something you should talk to your accountant about. So, retained earnings first. Quite simply, your retained earnings figure is what your balance sheet had for equity at the close of the last financial year. So at midnight on June the 30th in the last year when your books were shut off, that was the value of the equity and it gets carried forward into the new financial year. The second part here is your current year earnings. In this example is 20,000. Now your current year earnings is quite simply the profit from your profit and loss statement. It reads directly across to your balance sheet statement. So in this instance, this business in the year to date has a profit running at $20,000. So the $20,000 that the business has generated plus the equity that it had in the business last year gives a total equity of $60,000. So, covering it off again, assets minus liabilities equals equity. This side of the equation added up to $60,000 and this side added up to $60,000. So, all in all, I hope that's given you a slightly better understanding of your balance sheet. Now, an interesting exercise to do when you are looking at your own business, a couple of things, is looking at what the balance sheet looks like year by year. So if a business is growing, we're of course going to see a growth in our equity. If a business has been slowly going backwards, then we're going to see a negative value or a decrease in the equity over time. Obviously, we'd like to see the assets going up and liabilities going down over time, but it needs to be taken in the context of what you're reading. It's also an indicator of whether a business is what we call solvent or not, in that it has enough money to cover its debts. So in this example here, we've got $122,000 in assets and $62,000 in debts. So the ratio of these two is about 2 to 1. Anything from about 2 to 1 up to 4 to 1 is a healthy ratio. If there was more owing in this column than we had available, then the company would be insolvent, and we better fix it pretty quick. So there's the balance sheet, an extremely important financial statement for your business.